Thank you, Shaun, for meeting with me today. So what I wanted to review was a case study focusing on renegotiating deal terms after a lower practice appraisal. So a pretty specific topic, but I was thinking if you could first discuss the possibility of having to renegotiate deal terms after a lower practice appraisal comes in.
Okay. And I think that the main cause for a practice appraisal coming in lower than the agreed upon selling price is really unknowledgeable brokers who are typically generalists and lack the depth of knowledge needed to value a medical practice properly. So they set unrealistic expectations with the seller. They go to market with an inflated asking price, and then they end up attracting an unknowledgeable buyer who doesn't realize the asking price is inflated. And therefore, they go under contract, the buyer goes to get financing, and then it's when the appraisal report comes back, they realize they have a problem.
Okay. So if you had to pick what the main cause would be for a practice appraisal to come in lower than what the agreed upon selling price is, what would you say that main cause is?
Again, the price that was agreed upon in the contract isn't anywhere near reality. And so when the appraisal report comes back and the appraiser uses, sound reasoning
Hmm.
and three approaches to value, there's a big gap between what was agreed upon and what the appraisal report came in at.
Okay. And from your experience, is this a common occurrence?
Not with our firm. I can think of one, maybe two instances in the history of our firm where we had an appraisal problem. And we're going to talk about one of them today, and we anticipated that up front. But I think it's more prevalent in the general business broker community.
Hmm. Hmm. And are there more common, is this more common with certain types of practices or buyer types or transaction types that you've seen?
I wouldn't say, I think it's more related to buyer type and kind of goes back to that first answer, and that individuals individual buyers typically don't have the financial ability to do the purchase with their own resources. So they need to go to a lender to get financing. And depending upon the purchase price, there will be an appraisal involved. And so they're individual buyers because they lack the sophistication level of strategic buyers and institutional buyers. They are more likely to go under contract at an inflated purchase price.
Hmm. And is a practice appraisal necessary or requested for every transaction?
No, it's not. No, this is often a lender requirement. So if a lender is involved, typically that would be a conventional lender or an SBA lender, and the purchase price exceeds $500,000, then typically they are going to be required either internal bank policy or SBA guidelines to go obtain a third party appraisal. But if it is a strategic buyer or institutional buyer, they're going to use their own internal capital, or
Hmm.
they have a relationship with a private bank, or they have an existing line of credit, or they have an equity partner that's going to be funding their growth plan and providing the capital. So in those situations, those types of buyers would not need a third party appraisal report, typically from a conventional bank.
Okay. And is negotiating the deal terms really the only solution besides lowering the sales price?
The short answer to that is yes, but there's a couple ways to handle that. So if there's appraisal issues, I can think of at least three examples that could solve this. One would be the buyer agrees to close at the original contract price. Seller's stuck. Seller says, no, I won't budge. Buyer really needs to purchase the practice, and so therefore agrees to pay a price over and beyond what this third party appraisal report says it's worth. That's one solution. Another solution would be that the seller agrees to more favorable terms in exchange for agreeing to a lower price than what was originally uh, agreed upon in the original purchase documents. And that might be the seller financing note might have a lower interest rate, which would be a
Mhm.
benefit to the buyer. So you're trading one thing for another. Seller isn't, so they are kind of offsetting each other. Another solution might be seller agrees to a longer loan amortization term to make those
Mhm.
payments more affordable to the buyer. Another solution might be seller agrees to a lower compensation amount post sale for the transition period. So all of those things could come into play as part of the compromise between the buyer and the seller for this appraisal problem that they need to resolve.
Okay. And you mentioned before you've dealt with this once or twice in the past. Would you mind reviewing anonymously a real life example of this scenario and how you went about handling it?
Yeah, so this was a family medicine practice that had a significant number of senior lives in the practice,
Hmm.
and we knew that the bank doesn't understand what the value, what the opportunities are in the value-based care market. And so they would strictly look at this from a financial model, and oftentimes they're looking at lending a percentage of gross revenues. And, and if we went with the typical rules of thumb that they use for gross revenues, we knew we were going to be about 50% short of what the true value was for the practice. So in this particular case, we were dealing with both not only the sale of the practice, but the sale of the building. And overall transaction amount was about $3.2 million. But the practice portion of it was worth $1.45 million. So appraisal came in at approximately $750,000. And we needed to cover the shortfall. And so what we did in this particular case was we structured two seller notes. One seller note was for a lower amount, and the second seller note, and that lower amount, the note number one, was for a lower amount because it had to comply with the standby SBA standby loan rules.
Hmm.
And the second amount was not involved in this standby requirement, and that one could be start getting repayment on immediately. And so I believe in this case it was about 200,000 was the note amount that was on standby, and then you had another 500,000 that was able to be repaid immediately following closing on the schedule that was agreed upon among the parties. And we had that flexibility because we also were dealing with the real estate. And so we could move some of the seller financing off of the real estate and push it more onto the um, practice component. And so we had more options to work with, but that was the solution that we had there was the bank came in and lent money up to the loan, up to the appraisal amount. And then the seller knew that they were going to need to be the lender in second position with seller financing
Hmm.
for the remaining 50%.
So you get to use your creative part of your brain when these things happen.
Yes, yes. And unfortunately, we had a great lender in that one that
Hmm.
was able to work with all these complexities and put it all together. So it was a lot of fun. It was a great result for our client.
Wonderful. Well, thank you so much, Shaun.
My pleasure. Thank you, Kathy.